Okay, chapter 8. Now we're going to talk about the allowance method for writing off uncollectible accounts. So the idea behind the allowance method is that up front, generally beginning of a year, end of prior year, we would, usually end of prior year, we would estimate how much of our current receivables we are not going to actually get paid for. Okay. Why do we do this? Well, one reason is because if we do that, we can create a contra asset that actually shows our accounts receivables net of what we actually think we're going to receive. So let's say that I have $1 million of receivables. Let's say I'm a company that has a lot of bad debts happen. So I think 200,000 of that I'm never going to see. Is it more accurate for my financial statements to show $1 million of accounts receivable, or is it more accurate to show 800, which is what I actually think I'm going to receive? And the answer is more accurate to show the 800, even if that's a little off, even if it's really 810, or even if it's really 790, or even if it's really 840, that's still better and more accurate than the $1 million number that I had before, right? It's closer to being exactly right. It is still an estimation. But even at that, we still utilize the allowance method to be as accurate as we can with that estimation. So we have X-Tone Industry here. I'm on page 384 and then over to page 385. X-Tone Industry says at the end of its accounting period on December 31st, they have accounts receivable balance of $200,000. So I'm just going to type that out here for reference. Accounts receivable balance is $200,000. Okay, so we got that. And it says based on industry averages, they estimate that $30,000 worth of that is not going to be received. So they estimate they're not going to see $30,000 worth. So what we're going to do with the journal entry is we're going to write off and put into a contra account the allowance account for the allowance for doubtful accounts is the title of the account itself. We're going to put in that contra account to show on our actual balance sheet more accurately what we think we're actually going to receive. So just like the last one, we debit bad debt expense for $30,000, and we credit the allowance for doubtful accounts for $30,000. And what this does to our balance sheet, so let's say this is part of my balance sheet over here where I've got AR for $200,000. What this does is this is a contra asset. The allowance account is a contra asset for AR. And since it's a contra asset, that means its balance is a credit balance. So it's a negative number compared to this number because it's account receivable is an asset. So it'd have a debit balance. My allowance account is a contra asset, so it would have a credit balance. So the net AR is adding those two together. But again, that's more accurate because 170,000 is more likely what I'm actually going to receive. So it's kind of like a reevaluation of that actual asset. And that's what the allowance account does. The other thing that this does by setting this up ahead of time, by setting it up before I'm even writing these accounts receivable off, is it follows the matching principle. So remember back to chapter probably 2, maybe even 1 in this book, we talked about the fact that my expenses should match my revenue. So the term or the time frame in which the revenue was earned should also have corresponding expenses incurred to create those revenues, right? To earn those revenues, anything that I spent in order to earn those revenues. Well, bad debt is an expense that just happens. It's a natural expense of business. Not everybody pays you. It happens. By journalizing this on December 31st, I am now reducing my net income by the amount that I'm not going to receive. And more importantly, the revenues were booked in the prior year already because I would have debited accounts receivable for all these sales and credited sales. So this puts the expense into the proper period that matches with the sales, the revenues from when the sales were actually made in the prior year. And then as time goes on through the year, when we find some accounts that we don't have, like that we don't think we're going to receive, again, past due, bankruptcies, any of those types of things, then we will write those off. So this is the establishing of the allowance account. Okay, this is establishing it. And it's really establishing it for year 1 if we're talking about the balance sheet method. And we'll talk about why year 2 is different later. But this establishing the allowance for doubtful accounts. And then it goes on to say, what happens if this John Parker individual does not pay us? Okay, so they have an account worth $6,000 receivable that they owe us. and we either can't get a hold of them, or they've gone so far past due, or whatever the elements of it are, we don't think we're going to get paid. Well, what I do is I use up some of that allowance amount. So the allowance for doubtful accounts gets debited, for $6,000 in this case, and the accounts receivable gets credited. So we're getting rid of the receivable to show we no longer owe it, and we're debiting the allowance for doubtful account. Effectively, we're using up some of this $30,000. So notice that when it comes to write-offs, we're in both cases we are crediting the accounts receivable account because we need to show that we're no longer owed that. Also, in both cases, if they come back and pay us, we reverse it. But at least both methods, we are crediting the accounts receivable account to show that we're not going to get that. Okay, not going to receive that money. What does this do to our balance sheet? So remember, this is just a partial balance sheet. It's really not even really a partial balance sheet. It's just the one part. What is that going to do overall? Well, let's see here. We had our and let's just say this is right at the beginning of the year, so we don't have to worry about did other people pay us or anything like that. So let's make the assumption this happened right on January 1st. I know it says 21st on this one, but let's say it happened right after the end of the year. So my balance before this transaction in AR and allowance was $200,000 for accounts receivable, and allowance still had the $30,000 in it. What does this transaction do to those? Well, AR had $200,000. It's an asset account, means it's a debit balance. We credited that account, so it reduces accounts receivable by $6,000. So I can take 200,000 minus 6,000. That would be my new balance in AR, assuming this balance still held, and this is the only transaction that occurred in the new year. Then I have my allowance account, so I can net it just like I did above, right? Well, the allowance account has a credit balance in it. I'm debiting it, so again, it reduces it by $6,000, going the opposite direction. I'm reducing the contra asset account for $24,000. So my net amount, my net AR, notice, does not change. Exactly the same, which means I've used up some of that allowance account that I've established, and assuming that estimate continues to go down, eventually, I should write off hopefully approximately $30,000 worth of bad debts, specific to the $200,000 that I had outstanding, accounts receivable outstanding, at the year end. Okay, so the next thing, actually we'll stop this video here and go on to the next video for estimating our bad debt.